Goeienaand en 'n hartlike warm welcome from Citadel to this evening's webinar. My name is Yolanda Naudé. I'm an investment strategist and portfolio manager at Citadel, and I'm joined this evening by Mike van Westhuizen, a senior portfolio manager. We are both part of the Citadel asset management team. Mike, thanks for joining. I'm quite excited because this evening we have the opportunity to pick the brain of a real expert, because one of Mike's core responsibilities is the management of the South African Bond Fund. So Mike, be prepared. From a practical perspective, if you do want to post a question, you're welcome to use the Q&A box. We aim to get to the questions at the end of the session, and if we do perhaps run out of time, then Mike or I will get back to you and answer the questions for you in the next couple of days via email. Before we delve into the details of today's budget, we thought it could be useful to just create a little bit of context around the budget. Mike, and I'm going to ask you to help us to understand why the budget, the tabling of the budget annually is such an important event on the economic calendar. And how has the fiscal landscape in South Africa changed over the past 20 years, let's say 10 to 20 years, to get us to this point where we are today?
Hi, thanks, Yolanda, and good evening, everybody. Great question. So, Yolanda, we're going to go through a quick couple of slides. I mean, the budget, in essence, is important because if you think about your household as an example, you bring in money and you spend money, and you obviously don't want to spend too much, and you want to spend on things that are not, not rubbish. You want to spend on necessary things. So if you take that to an aggregated level in terms of a country, and I'm going to just go through, this is the 101 slide for those of you who aren't familiar with all the technical terms, but essentially you've got the revenue side. That's the tax that comes in, and we are taxpayers. Most of us are taxpayers. You've got the expenditure side, is what the government decides to spend money on. And, there's discretionary and non-discretionary spend. Discretionary spend is, the things that like health, education, etc., etc. And your non-discretionary spend is things like interest expenditure. So that has to be paid to the people that lend you money. When your revenue is greater than your expenditure, the term used as a budget surplus. That's a good place to be in, because you can pay down debt, and then you've got more money to spend productively on things that matter. When your revenue is less than your expenditure, you find yourself in a budget deficit. And that means that you need to fill that hole somehow to be able to continue spending. How do you do that? You need to borrow money. So, in a household, you go to the bank and borrow money. You use your credit card. As a country, country needs to issue government bonds. And we are government bond investors. We need to assess the creditworthiness of that borrower in order to invest with them. And the more debt that the country has to borrow, the more your interest cost rises, and that's an unproductive spend. It's non-discretionary; it has to be paid, and you get into the situation where the more debt you have, the more interest you pay on that debt, the bigger your budget deficit becomes, the more you have to borrow. So it's this doom spiral of debt. Okay, so we'll get into the details in a while. Just looking at South Africa's situation over the past 20 years, the orange line at the top here is government expenditure, and the bottom line in the black is government revenue. You can just see there was this little wobble here in terms of revenue over, after the global financial crisis, and again during the COVID era. But you can see the crocodile jaws there, the divergence where expenditure has grown by a lot and revenues lagged. And the funny thing about expenditure is that it hardly ever falls with an economic climate. In fact, you have to up expenditure when things are bad, but your revenue falls during bad economic scenarios. That's something to note. So taking that revenue minus the expenditure line, you get your budget deficit, and this is divided by economic growth of GDP. And you can just see South Africa's history. So there was a very low budget deficit in the 2000s, the Trevor Manuel years, paying back down of debt with windfalls from the resources boom. And over the last, 15 years or so, we've had run persistently large budget deficits. Okay, so as I mentioned before, how do you fund that deficit? You've got to issue debt. And so our debt profile from 2010, where debt as a percentage of the economy was 20%, now sits north of 70%. And just to put that into numbers, it gets quite startling. So last year, the annual interest expense was 386 billion rand. Okay, so it's R1 billion a day the government spends just on paying interest on debt. Debt service cost as a percentage of the tax revenue that comes in is a quarter. So for every 25 cents of every rand is spent just servicing debt. So that's being pulled away from productive resources like education and health, for example. And this debt cost is growing at 13% per annum over the last decade. That's a historical number. So, and it doesn't show many signs of abating as we sit. So this for us is the biggest sticking point, and this is why we are super interested in the budget. How is Treasury going to get this number lower over time? And lastly, the big swing factor for everything. So for the assumptions that go into growth, and also as the denominator of debt to GDP and budget deficit to GDP, is economic growth. So if economic growth can be hiked higher through good structural reform, then it solves many problems. And just again, it just illustrates over the last couple of decades how economic growth has just structurally become lower. And this decade to date, so the last 5 years, South African growth is tracking at 0.3% per annum, which is anemic. It's not going to solve any problems. We need to get to 3% as an example. So Yolanda, I'll stop sharing here in terms of the context.
Mike, thank you very much for that context. And I suppose we can say a reality check, because those graphs are a stark reminder of the difficult space we find ourselves in fiscally. Back to today's budget. As you know, the budget is annually tabled in February, typically. And this February, it was again tabled and then postponed for the first time ever. And you would recall that in Feb, the Finman Finance Minister unexpectedly tabled a 2% planned VAT increase. And everyone was up in arms around that. And ultimately, the budget was postponed on that day. It was then retabled on the 12th of March. But the opposition parties, especially the DA and the EFF, rejected it. And subsequently, the budget was withdrawn. So it is an unprecedented third iteration of the budget that we have seen today. So we are absolutely grateful that it was passed and approved in a very civil, peaceful way in Parliament today, without any drama. And I guess what is crucially important in this third iteration, if you compare it to the budget on the 12th of the February budget, so budget 1.0, the essence of that is, and compare it to the second iteration where the 0.5% VAT increases were planned, the third iteration needed to fill a gross revenue gap of about 75 billion rand. Now, that is a significant challenge. And if you were to look at it, that's over the expenditure framework of around 3 years. Just for the 2025-2026 budget year that we are currently in, or fiscal year, that gap, if you include the reduction, for example, in economic growth numbers, is about 55 billion rand that the government needs to fill somehow, either by higher revenues or by cutting expenditure. So, Mike, in terms of your understanding of this budget, can you share the facts with us of what was shared? Is the government, via the Department of Finance, able to balance the books, or are they not achieving that objective?
Yeah, okay. So, yeah, good question. I'll just speak through the facts, and as you say, we'll get into the meat in a bit. But essentially, it's always good to look at the economic assumptions that government puts onto the table, and for the reasons I alluded to earlier, and that they form a crucial part in the tax revenue collection assumptions. So you can see from budget 1 to budget 2, we had the assumption for growth for this year, it was 1.9% coming into the year. That's been adjusted down to 1.4. Okay, and funny to note that 1.4 percentage growth for this year was actually the worst case scenario that was tabled in the budget 1.0 official paper. So that's become more realistic, and 1.6 to 1.8 in 26-27. This more closely aligns to our assumptions on growth. So we did downgrade growth specifically for this year based on some of the tariff uncertainties globally. The inflation numbers have also been downwardly revised somewhat as well, and that's also what we sort of seeing in the inflation picture as well. You've seen lower oil prices, a tailwind for lower inflation, and you've seen less pressure on food prices. So all in all, more realistic economic assumptions coming through from the government. And then just a quick highlights. Don't worry about all the numbers here because it can get a bit hairy. Yolanda and I are both dizzy from looking at these numbers all day. But essentially, revenue has been downgraded from budget 1 to budget 3, okay, across the board. And this is over the MTEF period. You've had expenditure come down as well, being revised downwards, and that's a positive. The budget balance in terms of the deficit has in the outer years come down. So there's a bit of next year, there's probably a bit of a slightly widening of the deficit. And as a percentage of GDP, I've just put it equals here because it's pretty stable. So in terms of the push for fiscal consolidation, which is a big term thrown around, the government is committed to fiscal consolidation, meaning that they're not going to let this debt to GDP or this deficit widen massively. And then importantly, the primary balance, so that's your budget deficit excluding interest expense. So the actual discretionary expenditures taken into account, that's actually expected to increase, and you want that to increase. That's how you sort out your debt. And then your debt to GDP ratio, however, rises quite dramatically from the first iteration of the budget to like 2%, but over the MTEF. But the fact is it's rising, and that is largely due to the denominator effect of the GDP number being revised lower.
Michael, thank you for that. Would you mind sharing again? I just want to pick your brain on some of the economic assumptions and hear your feedback on that. As
Sure.
we know, the global economic landscape and the outlook have deteriorated in recent weeks, and specifically after the 2nd of April's US Liberation Day tariff announcements by the Trump administration. And primarily at the moment, we don't see it in the growth numbers necessarily on the ground, but we see it in the confidence numbers. And consumer confidence has plummeted. And if you look at business confidence, those numbers are also at the moment under pressure because of the uncertainty that the trade war is creating, especially from if you are a company and you want to invest in your company from a capital expenditure perspective, people are holding back. And all of a sudden, you see the link of the uncertainty of the trade war coming through in sentiment and confidence indicators. And we've seen last month that the International Monetary Fund has reduced their global economic forecasts for this year and for next year. They, interestingly enough, had 3.3% for this year and 3.3% for next year. And they reduced the global forecast to 2.8% for this year and 3% for next year. So quite a significant downgrade, especially in this year, by 50 basis points. The base isn't big, so 50 basis points is quite sizable. And at the same time, in South Africa, they had 1.5% growth for this year and for next year. For this year, they downgraded it to 1%. So that's cutting it by a third to 1%. And for next year to 1.3%. You and I looked at the Bloomberg consensus numbers this morning. All the participants in the Bloomberg surveys who's submitting their forecasts and assumptions, their averages for SA growth of around 1.5%, you mentioned, in the 3 years. And that's in line with our assumptions and forecasts that we also use at Citadel in our analysis. My concern is that, yes, it seems as if the Department of Finance's economic growth forecasts are now more realistic. But if you look at the IMF, the current year's forecast is still sizably higher and significantly higher, and next year's forecast as well. Do you agree that introduces some significant forecasting risk into this? Because as we know, you over budget on economic growth, and the reality is starkly different. Your budget deficit and your debt trajectory numbers look significantly worse than anticipated. How big do you think that risk is?
Yeah, I mean, it is a big risk. And obviously, government or Treasury want to have the highest number possible in there so that they can demonstrate that their revenue collection will be what it needs to be. The risk is high because of uncertainty. Your forecast band becomes wider. So we might have a situation of some resolution in the trade uncertainty, and even a deal between South Africa and the US where things go well for us, and you have upside risk. But on the other side, you have that same muddle through kind of scenario that we've been used to over the last few years, where things don't go so well on the tariff side. There's some kind of disagreement with the US. And also all of the implement or the strategies and the structural reform that's been spoken about in the budget is not implemented as we would expect, which has been, I mean, that's the evidence points to that's going to be or likely to be the case again. So there is big forecast risk, and as I said, and we'll get to the expenditure side, but the expenditure side is where the big work's going to be done. So you can put all these fancy growth numbers in here and solve for your tax collection, but might not necessarily going to turn out that way.
Yeah. And I guess the other point to the same equation is the inflation forecast. Because typically, as economists or investment strategists, we wouldn't look at nominal GDP, but in the budgetary process, that is the crucial number, because that's the actual spend on the base of the economy. And interestingly enough, if you can just move your cursor to 2025's inflation forecast by the Department of Finance, that moved from 4.3 to 3.7. Now, we currently sit with a number came out today. Consumer inflation 2.8%. For us to average 3.7 for the year 2025, we probably need to get to inflation of 6%. So that seems like an overestimation for me, although it's been reduced. What's your view on that?
Yeah, you're quite right there. I mean, it is a bit of overestimation, but again, you don't want to, or Treasury doesn't want to downgrade the inflation forecast too low either, because your nominal GDP number, if the higher it is, also you can not doctor your tax numbers, but it makes your tax numbers look better. So I do think we're probably at the low end of the inflation cycle now in the short term. So we're probably troughed. Inflation is likely to go up, but to get to that, to average 3.7, it's probably going to be tough to get there unless there's a big change in the oil price to the upside.
So you agree there's some forecasting risk here in the basic assumptions?
Yeah, for sure.
Okay, if we can perhaps then zoom in, maybe just ask this before we go to the revenue side of the budget. Is there anything else in the assumptions that concern you or make you uneasy?
No, I mean, versus budget 1.0, it's been pretty, I mean, it's pretty measured, and I don't think there's anything that's overly concerning from my side. I don't know if there's anything you picked up on.
No, I think I'm glad that there's more realistic economic growth numbers going into the modeling. I am a little bit concerned about that inflation overreach. But as you say, they need to prop up the numbers a little bit, otherwise they have significant issues on the other side. So we just need a reality check on this and keep them honest in the process. But if we were to move to the revenue side, we noted that 75 billion gap in revenue because the 2 times 0.5% VAT increases won't happen, and that's been scrapped. And the 55 billion revenue gap that we need to fill for this year alone. What are you seeing on the revenue side that the government has done and the Department of Finance in order to fill that gap? They're reliant on SARS to some extent. They're doing some bracket creep. There's some sin taxes. Can you contextualize that for us, please?
Yeah, so I mean, it was obviously a very contentious issue with hiking any taxes this budget, because you had to appease, or Treasury had to appease most or all of the parties in the GNU. So we had that infighting from the VAT hikes, and you saw some interesting parties coming to the fore and voting for that second 0.5 hike out of nowhere, claiming victory for it, which was interesting. But yeah, the hands are tied this year in terms of the tax sort of implications. So we've seen that the bracket creep is the big lever that they pull. So you don't adjust your income brackets for inflation. So naturally you end up paying more tax every year. Government gets in more there. So it's at about 17 billion rand. Small increases there for the fuel levy. So I think petrol and diesel going up about 16 or 17 cents in, was it early June. That's also, it's small, but it's obviously, it hits on the wallet. And then also small above inflation increases in the sin tax. And there was we are looking for further tax measures in 2026. So there's a big 20 billion unbudgeted or unaccounted for tax increase or some kind of efficiency in tax that the government's looking to push through next year. So there's been some decent wins on the SARS front. So there was I think it was 9 billion over collection of revenue in this last fiscal year, which is good. And there's been money put into SARS now to increase that efficiency. So we talk about the term tax buoyancy. So how much for every unit of economic growth, how much tax can you collect? So, or Treasury and SARS officially want to up that number. So they want to get the biggest bang for their buck in getting that tax revenue in. So we could see some wins there. The minister didn't really talk about provisioning for that in by and large, but there could be some nice numbers that come through there. So potentially some small upside surprise, but I'm going to be interested to see what happens with that 20 billion next year that they've got to find.
But if you listen to Mr. Kieswetter from SARS, he's of the opinion they can easily fill that gap and we don't need to raise taxes by efficiencies at SARS. And Finman is capacitating them more and spending more on SARS in order to improve efficiencies even further and tax collection and debt collection specifically.
Yeah.
Now, in terms of tax revenue, we know that with the new two-part system, the retirement system that made withdrawals from a savings component eligible and viable from September of last year, about 45 to 50 billion was withdrawn by South Africans from their pension pots. And SARS collected a tax of 13 billion on that. Is there any provision that you've seen in the revenue collection side of things that's focusing on that again? Are they anticipating a similar number? Could that contribute to filling that gap?
They haven't accounted for it or explicitly in any of the documentation or in the speech, but I mean, I think from what I've seen, there's a good chance that there is a large withdrawal of two-pot again this year. You've already seen in the new tax year, draw down on the two-pot on pension funds, and so I don't think I think for Treasury that's just the additional windfall. I think trying to forecast or add it into their numbers, that's where your forecast risk can really go, because it's not really predictable. You can get a good idea and you can hold thumbs that it'll happen in government's sake, but it's not a given.
So it could be a nice windfall, but they don't incorporate it into the core budgeting process, although it's likely to happen.
Yeah.
Mike, and then that contentious so-called JIFECRA account, the account that SARS is managing on behalf of the Department of Finance, the Golden Foreign Exchange Contingency Reserve, where they're managing the value of the Golden Foreign Exchange Reserves and ensure a nice buffer to avoid specific calamities for either the Reserve Bank or the Department of Finance. With the gold price having run all the way through $3,300 an ounce, apparently there's an 80 billion extra valuation due to the gold price. Is there any indication of them dipping into that reserve again? I think if my notes are correct, they are using 100 billion this year and 25 and 25 each in the next 2 years. Any indication that the cookie jar is being dipped into even further?
Well, I can gladly say no. They haven't called on that. I think it's prudent. It was a big surprise when they first announced that they're going to be dipping their hands in the cookie jar, even though it is legal, et cetera, et cetera. It's just, it doesn't set a good precedent that every time your foreign exchange reserves get revalued, that you can just rely on that to take, to plug that hole in your deficit. So it hasn't been any, I mean, not to say that they won't do it next year if they have to, but I think it's a good call not to make use of that again. Because it promotes the wrong behavior. So if you get bailed out by something that you have no control of, the markets control that, then you're not going to make the hard calls specifically on the expenditure side. Yeah.
It's almost an easy way out, but the wrong easy way out. Michael, do you want to share your slide on the expenditure side of the budget? Because we need to have a look here at what's been cut. We understand that the 5.5% wage increase for government employees, that's cemented for the next year. And there's potentially very little appetite to backtrack on some of the politically and socially sensitive spending, like, for example, the child support grant or the old age grant or the employment program. So I don't think there were any easy areas that could have been identified for significant cuts. Have they moved the deck chairs around and in the allocation of the spending? Haven't they allocated some of the anticipated increases that they budgeted for in 2.0? What are you seeing in the expenditure side? Is enough being cut in the right areas in order to make the books balance without hurting the economy and the initiatives to fuel economic growth and to maintain fiscal prudence.
Yeah, I mean, this was an interesting one for me, just to analyze the sort of trend this year. So this table is not all expenditure. This is what was introduced, or additional expenditure introduced in Budget 1.0 in February. And this was basically the reason why the tax or the VAT hike was put on the table to fund all of this expenditure. So they've had to, or Treasury's had to backtrack somewhat on this. And I've just shown here the changes in the numbers. And also, don't worry about the exact numbers, it's about the trend. Budget 1 versus Budget 3, and some of there's even a Budget 2 adjustment in between. And you can see there's, the government's focus has been on infrastructure spend. So they've cut 12 billion here. Large part of that is the PRASA allocation, and the nuance there is that there are some projects or that aren't necessarily needed right now in terms for PRASA. So that's maybe it's a prudent place to cut. I mean, in general, you wouldn't want them to cut infrastructure spend in general, because that is the growth driver. So we'd want to see more infrastructure spend rather than less. Early retirement costs, there was a drive to push some of the older workers out of the workforce to lower that wage bill going forward. That's been cut. I mean, it's neither here nor there. It's not really a needle mover. The big contentious one that still hasn't been addressed in the outer years of the budget is this COVID-19 social relief of distress grant, 35 billion. And you'll probably be familiar with the court ruling a while ago that the court ruled that actually double the amount of recipients are actually required by law, which would push this number to 70 billion. And there's been no provision in the outer years for this. So this could become a massive problem. It's still being challenged in the court, but if this has to crystallize in this budget, then we've got, that's 70 probably, 210 billion rand that you've got to suck out of thin air, which is very, very dangerous.
Can I just say on that point, Michael, the court's ruling is that SDR grant has to be made permanent. Now, there's a glaring omission for me there. There's one provision being made for this fiscal year, 35 billion, and then nothing else. So from an execution and a forecasting risk, from a budgeting process perspective, the omission of it in 26, 27 and 27, 28 is, for me, one of the biggest risks in this budget.
Yeah. And I mean, that's what you have to do as Treasury. You need to try and move it, as you said, moving the deck chairs. You have to avoid things that might be a bit inconvenient going forward to try and balance this budget. So that's why you need to have this analysis to get to this point where you say what's realistic and what's not. And as you say, this is one of the biggest risks going forward.
Apparently, sorry.
Yeah, no, carry on.
Apparently, the Department of Finance and the Department of Social Development, they are going to appeal that ruling. So that's one thing, a court process. But if they fail, and the court seems absolutely steadfast in their ruling, then that is absolutely permanent, and it's double the amount currently that we're seeing.
Yeah.
So another 35, or I should say, doubling it to close to 70 billion per annum permanently. That's a huge risk.
No, it's huge. And then just quickly, while we're here, the provision allocation for frontline services. So they've cut the additional spending in health and education of 17 billion lower. That is 17 billion of this 41 billion. And I mean, I think that the promise was to bring more doctors to the front line. So that's still happening. So it's other parts of the health sphere where they'll be cutting budget. So you can just see here the numbers, and this is over the next 3 years from wanting to spend additional 252 to now to 180. And then the small allocation, new allocation now to SARS. Okay, so obviously that's trying to milk as much as they can out of the tax base, from efficiency gains, then having to cut these expenditures. And I mean, I don't know if you're going to speak about it, but for me, if I look at this overall, this is for the easy expenditure cutting. This is plugging, solving for X, having a month or two to do it. So we're yet to see the real, the tough conversations about expenditure that is wasteful. I
Yeah.
mean, we can look at government procurement, for example. There's contracts that have been negotiated that are way above market related. And part of that is even, the massive property or the portfolio that the government leases. There's contracts there that have been struck for multiple years that are just way overboard. So, I mean, we joked about it earlier, but we say, SA needs a similar to a Doge, what Elon Musk is doing in the US, to go in and just look at where money is being spent. Government has in their to their defense said that they're going to start looking at weeding out ghost workers, so people that are on the payroll that don't exist. So there's steps being made, but there needs to be, proper sit down and say, listen, guys, we need to prove to investors and to our population that we are serious about cutting expenditure, not just nibbling on stuff. I mean, this is like giving a kid a sweet and then taking it away again, or biting half of it off and saying, sorry, we can't give you that whole bag of sweets. It doesn't sit well with if I look at myself as an ordinary citizen, not as an investor, because obviously as an investor they must cut where they can. But it's a difficult one. It needs to be solved.
One almost wishes for a zero budgeting approach, that they start from scratch, and each department has to table their own budget and it has to be approved from scratch. But that's unlikely to happen.
No,
Michael, you note the cut to the health department. Does that mean that the National Health Insurance Project, if you want to call it that, that's not gaining momentum? There's just not money for it.
Yeah, I think politically that's fallen so far by the wayside now that I mean it's not a worry for us in the short term at least. It might start coming back in around election time or something. It's always popped up here, but the fact is there's no way we can afford it. There's absolutely no way. Yeah,
I agree with that. And then, sorry, I can't not ask about the SOEs. Anything about Eskom, any additional support there, Transnet bailout, anything about that? If you look at the other SOEs, contingent liabilities, provision, VAT, budget, what are we seeing? We've heard very little in the budget speech. Did you pick up in anything in the tables, in the detail of the document?
Yeah, I mean, we sound like a broken record every time we speak about the budget from whoever our team does the budget, this budget talk. But no, it's convenient to leave out those contingent liabilities or future support for the SAEs. Most of them are not well run financially and they're under pressure. Let's call a spade a spade. So there's no provisions for Transnet. There's talk about potential government guarantees on the debt, but that hasn't been announced. I mean, that just shifts the debt from Transnet to the government balance sheet, which then just raises the debt to GDP ratio. Then you've also got the smaller entities, the post office. You've got
road accident.
Road accident fund also with holes. So no, there hasn't been any contingent liability or contingencies accounted for those, but we know they're there. It's just a matter of time. But in a best case scenario, with the focus on the rails and ports and all of that, maybe we get a decent turnaround story in in Transnet, for example, where it starts to become a little bit more financially viable, where the government doesn't have to step in all the time. But as it stands now, we're not there yet. That risk looms large.
It does seem as if the government is in Operation Vulindlela with economic reforms, also now incorporated the municipalities, the local governments, as they call it. I'm reading, I hear noise, and I'm reading about potential government guarantees for municipal debt. So what that could mean is, let's say a municipality of City of Cape Town goes to the Development Bank and borrows 100 million or 100 billion, but then the government stands father for that. Is there provision for that, or is that just still happening at the back end?
No, that's also still talk. I mean, you can say the municipality is arguably the biggest risk to the country, because that's where all the malpractice and stealing and looting and all of that is happening. And it's very difficult to try and go and ascertain and audit everyone properly and make sure that everything is working well. So that's a looming problem. I mean, we've seen. We've had issues with City of Tshwane, for example, over the last couple of years, where the debt of their debt, spreads are rising massively because they can't pay the interest or debt restructuring and all of that, which is going to be a problem, government's problem at some stage. And then also, if you add on top of it, with the municipalities owing Eskom money as well, it's like this loop where they owe 95 billion rand to Eskom amongst the municipalities, and about 20 odd billion to the water board as well. Which government might also need to somewhere along the line take over. So there's a lot of risk there, a lot of execution risk. There needs to be a bigger focus on that. And I'm hoping Westhuizen does cast more of a BDI over those municipalities in trying to rectify things.
Because they do remain the weakest link in the economic chain. By far. Michael, would you please put up your slide again when we talk about the budget deficit? And if you don't mind just zooming in a little bit before we go to the deficit path projected for the next 3 years, just zoom in a little bit on the primary surplus, perhaps just explain that and contextualize where we are relative to what was budgeted. Can we be pleased with that?
So one of the things that Treasury has gone out and set out to do over the last few years is to attain the primary surplus. And essentially what that is, it's your revenue minus your non-interest expenditure. So it ignores everything that you're spending on debt to try and ascertain whether you still, the discretionary spend is lower than what you're collecting in terms of tax. So it's a positive that we are in a surplus, but the devil's in the detail here. And the link between the primary surplus, it's with paying down debt. Okay. So if you can attain a primary surplus, so you have more revenue than your non-interest expenditure, you can use that little bit of buffer to start paying your debt down. The problem is here that you need your primary surplus it needs to be close to what you're spending on your interest. So it needs to be more, because if it's less, you're just chipping away at that interest, but you're still paying interest on that debt. You want to get to a stage where your surplus is bigger than your interest payment. So you pay down your interest, almost like when you're paying a bond down, you pay down your mortgage bond, you pay down your interest, and then you start eating into the capital. That's what you want. So we are heading in that direction, but we're not quite there yet. So it's a positive steps, but we need to see a lot more. So, for example, you need to see we spoke on nominal GDP growth. If your nominal GDP growth can get close to your interest, your cost of debt, your interest rate on your bonds, then you're winning. Right now, our bonds is 10%, and we 6%. There's a 4% gap that we need to fill.
It does seem as if the primary balance, if you move your cursor perhaps to budget 3.0, that line, from a 0.7 primary budget last year to 0.8 this year, and then jumping to 2.1. That sounds phenomenal. Is that realistic? Is it achievable?
Look, anything's possible, but again, it goes back to all the assumptions on, is the growth assumption right? Is the revenue assumption therefore right? Will government come next year and find that 20 billion of expenditure or additional revenue, and then do the hard yards on cutting the expenditure that we spoke about? So it's doable, but the evidence here, if you look, if we be realistic here, it's been difficult for Treasury to attain these, keep these targets.
I guess to vastly improve these numbers and to get to a primary balance of 2.1% in the outer year 27-28, there needs to be significant fiscal pain on the expenditure side, which we're not seeing. Can you move your cursor, please, to the budget deficit, just a block above that? Budget deficit 25-26. So am I right in saying that we are witnessing some fiscal slippage? In budget 2.0, the 25-26 budget was planned or was budgeted for a deficit of 4.4, slipping to 4.6. And the other years don't look significant in terms of the difference there. So there's a little bit of fiscal slippage, but it's not a disaster.
No, because if you look at the ratio here, the denominator being the GDP numbers, the thing that messes it up a bit. Because if you look at the underlying detail in this budget, more expenditure was cut than the revenue foregone from not doing the VAT. So there is a little bit of fiscal slippage, but it's a little bit of a technicality. And if it was a big number difference, like a 50 basis points or something, then we'd probably start to worry more about about that. But I mean, it's not a good picture in any case when things start to slowly, incrementally derail as they are. So we need to keep a close eye on it.
And I guess what's also crucially important is to see if the reduction in the deficit is still there in the outer years from, okay, a little bit more now, 4.4 to minus 4.6, but then the downtrend continues. So it's not as if we are aborting this more prudent fiscal path.
No. So exactly. So that's positive.
Okay, and that takes us into the debt to GDP ratio, or debt as a percentage of the size of the economy. There we're seeing more slippage. So it feels to me as if the stabilization of the debt trajectory remains this elusive matter. We just don't seem to get there. It's just always pushed out. And again, it's pushed out with this budget. Does it disappoint you? What's your take on that?
Yeah, it disappoints me, but it shouldn't, because I saw an interesting fact today that over the last 14 budgets, Treasury has missed on their targeted debt to GDP ratio. So for the last 14 budgets, it's just they've just forecasted their debt to GDP. So it doesn't surprise me. It's disappointing, and obviously it becomes a rating agency problem at the end of the day, because they're going to watch very closely. I think 80% is a hard no line in the sand for a lot of the rating agencies, and we're creeping up towards that. I mean, if you look at what the IMF has forecasted for us, we get to the 80% next fiscal year.
Sure.
So a lot of work needs to be done here. And again, it's your GDP ratio here your GDP number as the denominator here has been the largest cause of this trajectory. So it's again silver bullet. If we can implement all of this infrastructure, structural reform, Operation Vulindlela, debt growth, I mean, we need to get to 3% realistically, but I mean, I think most people would take 1.5% as a start now, just to get the cogs turning, so that we can start chopping away at this number. Because, the worse it gets, the less you want to hold the debt, because you get that downward spiral. I mean, rising debt to GDP is one of the largest contributors to your yield of long-term bonds, specifically in South Africa. I think 70% of the yield is explained by this ratio. So with higher debt, there's a high chance that you can't pay that debt, and therefore investors ask for higher yields, or they want a much higher yield on your debt to be enticed to buy that debt.
Compensate you for the risk.
Exactly.
So there's a big difference between the IMF and Budget 3.0. There's not a lot of difference in the economic growth forecasts, but I think the IMF was quite explicit that they see the bailout of the SOEs as a continued and rising risk.
Yeah.
So that's why their debt to GDP ratio is significantly higher in the outer years.
Yeah, exactly.
And that remains a risk.
Yeah.
Mike, the opposition parties continue to say that the budget isn't pro-growth enough. Is there evidence in this budget of an allocation of money to provide for new growth?
Yeah, I mean, look, the infrastructure spend, you can argue, is a pro-growth agenda, I'd say. But again, like I mentioned, it's on the margin still. The intention's there. The funding is there. It's, again, implementation. But I still think it's a pro-growth budget relative to what you've seen. If we look in the last even 10 years, only in the last couple of years, that's been the focus again. Shift towards growth rather than just trying to, spend on social welfare and all of that. You need to actually grow the economy to get people out of poverty.
Yeah.
That's the only way.
Yeah. You mentioned infrastructure. Am I right in saying that the government is putting the responsibility of the infrastructure spending on the local governments, the municipalities, and that's where it could fall flat?
Yeah, that's also it's a good point. So it's a surprise. They allocate. I think they wanted to spend R1 trillion on infrastructure over the next 3 years, but in the budget coming from government, it's tiny as a percentage, and that relies on local government, relies on the private sector to also get involved. So there's big execution risk from that perspective as well, and you need willing participants to invest in the country, and that includes foreigners as well.
So the finance minister did explicitly mention Operation Vulindlela 2.0, the next phase of it. What stood out for you there? Do you see a real commitment to the economic reforms that should push economic growth higher, also facilitated via this specific budget?
Yeah, I mean, on paper, it says all the right things. You know, but I mean, Willem-Dlela one essentially is probably the more important one from a structural perspective. It's, you know, your logistics, electricity, your water security. I mean, that's been a problem. I mean, that's led to the degradation of a lot of the country, a lot of the municipalities as well. So that's super important. And then I think two was, what was it, local government. We spoke about that earlier. The others was the digital infrastructure as well.
And
the other one,
spatial inequalities.
Yeah. So I mean, that's a nice little add-on. But I think if we look at one, looking at infrastructure, like the actual infrastructure on the ground, electricity, water, all of those basics, get the basics right, and then the rest of the stuff follow.
Mike, can we now change a gear and make it practical? And we put ourselves now into your world as a bond fund manager. What do you think will the impact be of this budget on the view of the rating agencies of South African debt? I mean, fascinatingly, last week we saw Moody's, the rating agency, very delayed relative to its own peers, but downgrading and cutting the US debt from their AAA, stripping them from their AAA rating. So it's still investment grade, but stripping it from one notch. And they highlight their 6.2% deficit to GDP and the 124% debt to GDP ratio, and saying they're deeply concerned about the sustainability of finances in the US. In South Africa, you confirmed that the rating of South African debt by the rating agencies is a BB-, so it's already below investment grade. Is there anything in this budget that you think could scare the rating agencies and that they are losing their patience with our attempts at fiscal consolidation and an improvement in the overall finances? Or are we likely to see them sit on their hands and have a wait-and-see approach again?
Just on that US debt, we also had a joke the other day that it's interesting. We can use an SA debt analysis lens now to analyze US debt, because they're on that similar path. I think in terms of the SA and the rating agencies, I think the rating agency will be all right with this budget. There's nothing massively different from the previous two iterations of this budget. The government's treasury stuck to fiscal consolidations so far as they've kept that deficit number steady. I think that debt number is going to start worrying a couple of them. But I mean, we saw it was S&P last week that affirmed our not our rating, but our outlook on our debt. And you need almost an outlook downgrade before you start getting ratings downgrade. So from positive to neutral to negative. And we'll start to see that. But I think for now, this budget will appease the rating agencies for now. I mean, and they are very hindsight looking as well. So take whatever they say with a pinch of salt.
That's good news for now.
Yeah.
If you go one level deeper and you look at the impact of today's budget on bond yields, there's some fiscal slippage. You confirmed that, especially on the debt to GDP ratio in the current year. Are we likely to see more bond issuance? And from that perspective, more supply of bonds, putting downward pressure on prices and increased pressure on the yields?
Well, luckily for us as bondholders, there was no increase in issuance announcements. So, I mean, the weekly auctions that are going on, 4.75 billion rand issued every week in the government bond auctions. They've actually run a little bit ahead of the funding requirement so far, and government's got a reasonable cash balance now to draw down on as well. So there's no issuance implications for now. And I mean, the bond market today and the rand took the budget in its stride, and it was, neutral. We didn't see any. I mean, normally you see like quite volatile moves around the budget speech, and today was minimal. So I don't know if everyone was trying to focus on Ramaphosa's meeting with Trump, but the bond market and the rand were appeased by this budget.
So, Michael, with the R209 bond, I think it matures in 2036. So let's call that a 10 and a bit year bond, trading at around 10.8%. What is your view on South African bond valuations, and how are you positioning your bond fund?
Yeah, so it's always a good question. So you get the fundamental case that we've just spoken about now. So, it's not looking amazing. So we've got rising debt to GDP. Okay, so from that side, it's maybe a neutral to negative tick. But then also, it's what opportunity your yield gives you. Is your yield compensating you for that risk? And again, over our sort of assessment in the medium term, we see SA bonds as fairly valued where they are now. So you can plug into an equation all the variables, the US bond yield because that has a big bearing on our bond yields as well, the US 10-year bond yield. You can place the debt to GDP ratio, and then we around about fair. I'd say over the longer term, I'm still worried. I still get worried about this debt trajectory and probably less positive on bonds in the longer term, but we can't invest looking 20 years on the line from a tactical perspective. We need to try and get in and out and we see value. So yeah, if the sort of bias, as the market's been relatively strong over the last couple of weeks, probably look to trim into any further strength in the bond market as a general rule of thumb.
So if you mean fair, you mean it's fairly valued in your view. You're not overweight or underweight. It's kind of fairly valued.
Yeah, we neutral view to SA bonds. Yeah.
With the aim of trimming your exposure or your interest rate sensitivity, trimming into strength.
Yeah.
Okay.
Good. Yeah, and that's if you look at the view that's leading up to the NTBPS in October and then next budget in Feb. So if things change for the better, if we start to see on the ground data looking better, then we have no reason to sell. Then you have to look at opportunities to buy again. So it's a moving target.
Moving target.
Yeah.
I want to pick your brain on the inflation target. Now we've had an inflation target in South Africa for years of between 3% and 6%, and we know the actual practical target that's been confirmed by the Reserve Bank in the recent years is actually that 4.5% midpoint.
Yeah.
Now, interesting, there's been talk about potential lowering in the target, and things have gone quiet. And then all of a sudden, Deputy Finman Mazondo last week, confirmed, noted that we could see a change in that target number soon. And we know that the Finman has expressed an explicit bias towards a target of around 3%. Current target, let's call it 4.5%, that midpoint, and then 3%. Now, I mentioned that inflation coming out today, consumer inflation 2.8%. So I guess if you want to change your target, now it's not a bad time because actually inflation is lower than the target that you may want to, that 3%. But sure, if you need economic growth of 2%, 2.5%, and 3% from a current level of very close to 0 to 1%, is it a move from a 4.5% target towards a 3%, not too aggressive and unnecessary almost, given the current lay of the land and the objectives to stimulate growth? It feels as if it's contrary and it's conflicting goals, almost in a sense.
Yeah. So yeah, I mean, it's interesting. It's an interesting one, this, and I think there was a throwaway comment today around the budget where someone said, I think it might have been the deputy governor again or deputy minister, saying there's no imminent changes, but there's going to be some talk about it or some report or something like that. But we'll have to see. But let me share something. It's good to try and illustrate this example because to get to 3%, you need to have some evidence that our inflation has structurally been around 3%, because then otherwise it's a dream. And if you look at it from a global inflation targeting perspective, developed markets sort of target 2%. Okay, so it's a thumbs up. It was invented by someone in New Zealand, I think, and that's a thumbs up. And on average, emerging markets are targeting about 4%. Okay, so if you look at us, I've just taken all of the items of the CPI basket here, and I've just highlighted the big weights here. So food and non-alcoholic beverages, housing and household utilities, transport, and miscellaneous goods over here. I've put out the 10-year average. So this is before today's print. So the March number 10 years back, the averages, the 5-year average, the 3-year average, just to get some sight of this any momentum shift in structural inflation in South Africa. There's not much difference over any of these 10-year, 5-year, 3-year averages at all. But you can see the 1-year average, by and large, a lot of these numbers are low. Okay? So the 1-year number gives this false sense of security that inflation of target of 3% is something that could be achieved. But if you look at all the other numbers here, I mean, the 3-year average inflation number at headline level has been 5.5%. Yeah, the 10-year numbers are 5%. And then you look at all the sort of the categories over here. Our inflation basket relies heavily on the oil price, the rand price of oil, because we are importers of oil. And that goes into many of the different things. Food price inflation, again, is out of our control. It's weather dependent. So those are two supply side aspects of inflation that monetary policy doesn't really solve supply side issues. You can't, it's more to stem demand, push inflation rather than the supply side inflation. And I looked at it another way, where you take all of the different items, and this is just categorized administered prices as a line item here. Okay, so administered prices, as we all know, it's the bane of our existence. Every year, NERSA comes and says, "Oh, we're going to want to hike electricity by 14% or whatever." And that's happened in multiple years in a row now. We're getting double-digit increases in electricity prices. So let's just assume that I made two assumptions here, that administered prices stay at 6% year on year. Okay, so that's being kind because it hasn't been like that. And then the other assumptions, they stay at 4.5% like this current year over here. Okay, administered prices are 16% of the basket. So if I solve for the rest of the basket, okay, so to get to a 3% inflation rate, using a 6% increase in administered prices, the rest of the basket, everything else has to inflate at 2.5% on a year-on-year basis.
Sure.
Okay, so tell me here over history, where has that happened?
Yeah.
Okay, so 3% for me it seems like it's a pipe dream. I think more realistic, and we don't know what the proposal is. We speculating, we're making an educated guess here. Something closer to 4% might be realistic. I mean, even if they make the midpoint, that 4.5%, the point target rather than, and remove the band, it's also it's realistic. And at the end of the day, the rationale for trying to put the inflation target lower, ironically, is to actually get long-term interest rates lower. Because if you put your inflation target lower, you're trying to affect or influence inflation expectations. So if the whole economy's inflation expectations at 3%, then wage negotiations are struck lower. Try and push through big administered price hikes, less popular. The only problem is that government has to play along as well. You can't have government giving 5.5%. This last year they gave a 2.5% rise, over inflation rise in wages. You can't do that. So there needs to be participation by everybody in the economy, not just the man on the street. Government has to play ball as well.
Yeah, it seems to me like it's a fairly noble theoretical objective, 3%, but impractical for where we are at the moment, unless you kill demand completely in the economy, which is exactly the opposite of what we need.
Exactly. 100%. So the rate outlook now in terms of short-term rates, I mean, we expected 2 or 3 cuts this year still. If they don't change the inflation target, we might very well see one at the next meeting. If there is the sensitivity to this inflation target or changing the inflation target lower, then we're not going to see any more cuts, which is not great for the consumer.
So a lot depends on that target or not. Mike, I'm going to thank you for your valuable contribution. It was a pleasure picking your brain as bond manager. You allocate to bonds within the bond fund. I'm a multi-asset manager, and I allocate to the asset class within the multi-asset funds. And I think both of us will agree that South African bonds is a fascinating asset class, but that you have to handle it very carefully. And partly because of the impact of global investors. They typically come in, they see the juicy high yields, and they buy indiscriminately, and they don't focus on the fundamentals. They drive the prices high and the yields lower. The converse is also true. We've seen it over time. They can dump South African bonds for no good reason based on sentiment or emotions. And that can create opportunities for you and for me in the bond fund and in the multi-asset space. We remain acutely aware of the fiscal risks and challenges regarding South African bonds, and we remain absolutely steadfast in our valuation sensitive approach. So what can you expect from us with regard to South African bonds? If the yields in our assessment, the prices are too low and the yields are high and it's discounting too much bad news in the fiscal landscape, for example, you should expect us to buy bonds. Mike should increase his interest rate sensitivity in the bond fund, and I should increase the allocation to bonds in the multi-asset funds. Conversely, if the yields are too low and the price is too high, you should expect us to sell or reduce our exposure, or perhaps have no exposure in some of the funds. Over time, an active approach, similar to the currency management by Citadel, over time, an active approach to South African bonds has really proven its worth, and you can continue as a client to to absolutely know that we are doing exactly that in your portfolio, and with active management, aiming to add incremental value every time there's a sell-off in this asset class and we see good value. In closing, I thank each of you for participating in this webinar. We did not have time for questions. I saw that there were a couple of questions. We'll get back to you in the next few days. I'm going to close off and saying stay safe and warm as winter arrives, and thank you very much.